Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you. And before deciding to invest in foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading and seek advice from an independent financial advisor if you have any doubts. Welcome back to the webinar series on how to test a trading method. This is part 3. I'm Rob Booker. Part 3 concerns the out-of-sample period of testing. So far, we've set the stage by getting organized in part 1. In part 2, we talked about the holdout period, which is kind of like a sandbox. It's where you experiment with trading methods and figure out some things that you want to focus on. I want to remind you as we begin part 3 that I'm not an expert in scientific methods, I'm not a laboratory technician, and I'm not a professional hedge fund backtester system creator. However, the principles discussed inside of these presentations are reasonably standard operating procedures explained for the use of retail traders. You can always become more complex, and that's not necessarily a bad or good thing. And this webinar series of presentations is meant to explain principles in general form and get you started. I do believe, with that caveat, that if you follow the principles explained in these presentations, that you're going to come up with a trading system that's useful. And I look forward to explaining the second period of testing in today's webinar and taking your questions about how to get this done. The out-of-sample period is for confirmation, while the holdout period, in my opinion anyway, is for experimentation, and it's really a sandbox in which you decide on a set of rules by playing around. And the rules are loose and fancy-free, and you're just there to develop something that works. The out-of-sample period is more precise, and it's meant to confirm initial hypotheses that you created during the holdout period. Now, for some, in the professional world of investing and testing, the holdout period might also be extraordinarily precise. And I've created a presentation that explains the holdout period as a sandbox and compares that to the out-of-sample period that's for confirmation. And you'll find in your own testing and in your own implementation of this method what works best for you. But I like the holdout period as a sandbox and a playground, and the out-of-sample period as the busy work and the get your briefcase and go to work kind of section. The out-of-sample period will take longer than the holdout period. The out-of-sample period will frustrate you much more than the holdout period. And that's because the sample period is where you're really drawing some final conclusions, whereas the holdout period were preliminary conclusions, stuff you thought you knew but you weren't quite sure. These are the tools you need for the out-of-sample period. You need clear rules. Now, you were developing rules in the holdout period. You're not developing rules in the out-of-sample period. If you find yourself during the out-of-sample period testing, if you find yourself during that time making up new rules or exceptions, then you're really still in that holdout period. The out-of-sample period is meant to be a new time period separate from the holdout period that you tested, in which you confirm or reject the rules that you created in the holdout period. In order to do that, you need clear rules that can be rejected or confirmed. You need a spreadsheet this time. In the holdout period, you didn't really need a spreadsheet, but I think that in the out-of-sample period, you can't do without it. You also need testing software. You could do automated testing by running systems backwards in time on MetaTrader, but that carries with it a host of concerns. Does your data have gaps? Is the data that you're using reliable? Are you incorporating the spreads? Is it opening trades at the correct time of day? Some of you might think that testing with software backwards in time is easier. It's just a whole different set of problems. You don't need to backtest with software. Michael T. and Hector and Kenrick will confirm that in backtesting the Hector pivot bias trade, there was an extraordinary effort in just debugging the testing. And an individual who had raced to the finish to produce results with Michael's programming may have found that they could manually backtest the same amount of data during the time that it took to debug the software. That's not saying that Michael is a poor programmer. In fact, Michael is far above average in programming skills. Even with an above average programmer spending an extraordinary amount of time, automated backtesting does not necessarily speed up the process the first time around. It may be something that you want to engage in out into the future, but I need you to understand that you are not necessarily behind the 8 ball or at a loss or at a disadvantage if you do not have automated testing at your disposal. In the long term, bigger picture, technology accelerators like automated backtesting and automated trading can assist you and do have their place. But during the first time that you run through the process of how to backtest a trading method, you don't necessarily need or require automated testing software. I want to make that point very clear. You may feel that other people are going faster than you or slower than you. You may feel that it's automatically at a disadvantage if you don't have a computer running the tests. The fact of the matter is, people create terrible trading systems with automated backtesting software just as often as they create terrible trading systems manually testing. The higher truth is that most people do no testing and no analysis, and so most people are trading with incorrect assumptions and invalid trading systems that will be discovered as fraudulent only when they begin to lose, which is far too late in the game. If you are willing to do any kind of manual or automated testing of your trading system, you are far ahead of the curve and you are at an advantage. Remember that when you are backtesting a trading method or attempting to prove or disprove its validity, you are really in the end simply solving a problem. Trading is about solving problems. I mentioned this in the previous webinar. Maybe you're trying to catch a counter trend move. Maybe you're trying to catch a trending move. Perhaps you're saying to yourself, I'd like to use moving average crossovers. What's the best way to do that? Or I'd like to create a system that captures 100 pips. All of those are ways that you begin the process of creating a trading system. Some people solve a problem by saying, I'd like to find a way to trade the news, or I'd like to try to find a way to trade on interest rate differentials. For quite some time now, I've had it in my mind that I can create a trading methodology that builds a basket of currencies that are somewhat correlated, that earn interest overall if you hold them, and that you can wait for periods of time where the basket becomes uncorrelated, then buy the basket and trade the basket back into correlation while you make interest. Now that might sound like a bunch of gibberish to you, but it's been swirling around in my brain for quite some time. It's a problem. I'm thinking that there is a possibility that I could solve the problem of creating that basket, earning some interest, trading it when it's not in correlation. And in order to complete my testing of that method, I need to make a hypothesis, experiment, do some analysis, publish rules. After I publish the rules, complete additional experiments, and move on. The holdout period is the sandbox in which I create a more specific hypothesis. And in the previous webinar, we discussed the ways that the scientific method helps to create a more robust hypothesis. I don't think that the holdout period necessitates an enormous amount of time. I think you can pass through the holdout period on a variety of trading methods in a reasonably short period of time. However, the out-of-sample period will either confirm or reject your system's validity, and your testing here is more precise than from the holdout period. In the holdout period, you are in the sandbox, and in the out-of-sample period, in my opinion, you are in the laboratory. A system is valid if it returns profit in exchange for acceptable risk. I could make this slide the central feature of the entire webinar series and leave it at this, and if this is the only thing that you remember about the presentation and the webinar series, I'd be happy. A system is valid if it returns profit in exchange for acceptable risk. Look at all the ways that individuals out in trading land don't care about this sentence. A system. Most people don't have a system. They do not have an organized set of entry and exit rules at all. They break this entire sentence from the second word. Number two, a system is valid if it returns profit. Most individuals who are trading a methodology aren't even trading a methodology, as we mentioned. If they are trading a methodology, they don't actually know how much profit it returns on average. Most people cannot tell you what the average returns were for their trading method over the last 3 years and what the deviations from those returns were. All I mean by that is, what are the wide variety of possible returns your system could have produced over the last 3 years? Most people can't answer that because first, they don't know what the system is, and second, even if they do know the system, they don't know what the returns were. You are far ahead of the game if you're even willing to make it through the first 8 words in that sentence. Number 3, in exchange for. Most people consider profit. They see some profit and they consider no exchange. They have no understanding of the trade-off they're making. There's no understanding of anything except for profit. It's all they can see. But a system is only as valid as its returns measured against its risk. Any profit that you achieve in a trading method comes at the risk of certain losses over time. And a system is only valid if it returns profit in exchange for acceptable risk. It's the fourth element of this sentence. Even if someone understands that their rules that they created return a profit that they can understand in exchange for some risk, many traders do not understand how unacceptable the risk is that they've taken because they don't know what the standard deviations or the wide range of risk that was possible in their system over the past 3 years was, or any time period. They could even tell you they have a system. They could even tell you that they know what the wide variety of profit returns were. But many traders cannot tell you what the variety of drawdown risks were in their trading system. They can't state it. They don't want to look at it. This one system summarizes the way that profitable traders trade for the long term. It's not random trading because it's a system. They understand what the difference in profit from year to year could be. They understand that they're trading that system in exchange for some type of risk, and they know what the risk is. If there's any element of this sentence that you can't answer about your trading method, in a short period of time by following the principles in this webinar series, you should be able to do that. What's the definition of acceptable risk? It's this: low drawdown. Well, what's the word low mean? Well, we'll talk a little bit more about that, but you just don't want to have a very big drawdown. You don't have to get all scientific about it. You don't want to have a drawdown, which is the greatest peak to valley loss in your account equity or balance over any period of time and course of trading the method. You don't want to have something that has a risk of a 50% drawdown. You probably don't want to have that. Why? Because historically, if you look over the course of history and trading methods, whatever your drawdown has been historically, you face the risk of something greater than that. The greater the drawdown, the greater the risk that your system will explode or that you will become so frustrated with it you'll stop trading it right at the moment when it was about to turn around. The greater the drawdown, the harder it is to get back to break even. You don't want to have a method that draws down 60 or 70% because then you have to create returns that are extraordinary in order to bring your account back up to normal. You want to look at trading methods that have short time periods of losses. You don't want to go through long periods of time with lots of losses. Why? Because that would create higher drawdowns. You want to have a small size of your average loss. In general, that is. You can have trading systems that have a larger loss. It's possible, and all of these elements play off of one another, but you don't in general want to create a system that has giant average losses. You want to look at the standard deviation of your returns. That's a simple calculation that you can do inside of Microsoft Excel that simply looks out over a complete year, for example, or a complete 3-year period of time, and says, what's the standard deviation from your returns? That gives you a range of returns that might be possible with your system. You don't have to understand the math to understand what I'm saying. Your system won't automatically produce 6% per year. It will produce a range of returns above and below 6%. And there are simple formulas that given your trading results that can be produced. Other ratios are also part of the understanding of risk. The Sharpe ratio that measures sort of how much risk you're willing to take on in exchange, or you are taking on in exchange for the return that you got. MAR ratios, and there are other formulas and ratios used inside of the world of trading. But you can reduce all of this to an easy question. You don't have to become a scientist. Microsoft Excel can give you the ratios, but only you can answer this question. Microsoft Excel cannot. Can I honestly say that I understand the risks associated with trading this method? And what are the risks? Why are they acceptable? The out-of-sample period of testing ought to give you enough information that you can answer this easy question. One troubling characteristic of most retail traders is that they do not like to answer this question. They can't answer it because they have no testing, and they won't answer it if they know the answer is no, it's not a valid system, because that turns off trading. And the worst thing you can tell a trader is to stop trading. The worst thing you can tell a gambler in Las Vegas is to stop gambling. Sir, can I ask you to step away from the table, is the worst thing that you can say to a Las Vegas compulsive gambler. It provokes anger. If you can't answer this question yes and in an honest manner, you need to stop trading until you can answer it. The dirty little secret is that within about a month or two, you can answer this question honestly and yes if you're willing to do the work. A lot of people over the years have become frustrated with me for a variety of reasons. I mean, you can read the stuff written all over the web. And they become frustrated with me for a variety of reasons. And in all fairness, I become frustrated with traders sometimes because they won't answer this question. You can say whatever you want about Rob Booker or Hector or Connie or anyone else who's out there trading. You can say anything that you want. These days you can write anything you want online. But I want it to be known about me when I'm long gone that I simply asked you to pose this question to yourself every time you were taking a trade. Can you honestly say that you understand the risks associated with trading your method? And what are those risks and why are they okay? Cloud computing is the new fancy term. Everybody talks about cloud computing. I want to talk for just a moment about cloud testing. It's the process of testing a trading system with your head stuck in the clouds. Cloud testing tells you what you want to hear. You simply say, oh my gosh, look at all those winning trades. You don't know how many people have come to my office or sent me charts and show me the best example of a trading system. And they say, look at how much money that made. I have no interest in that. It is boring and stupid. Nobody wants to see the best example of your trading system chosen at random to prove that you have a good trading system. No one wants to tell you what you want to hear. Only you want that. Nobody cares about the best example. Nobody. You'll never get it anyway, and you'll have to throw it out because you'll close the trade early or you'll sleep through it. It's the worst possible thing that you can do is to tell yourself what you want to hear. If Hector spent 3 months trading or testing the Hector pivot bias trade exclusively on the excitement associated with seeing one trade that made 500 pips, we would all know that Hector was headed for disaster. Do you know why Hector has been testing that method? Not because it was profitable all the way along. Through the holdout period, as we were creating the rules of that trade, it was actually unprofitable. The system wasn't telling Hector or anyone what we wanted to hear. It was frustrating us. But it had the potential to be consistent and stable over time. And so we stuck with it. We didn't stick with it because it was going to catch the big one. Cloud testing, or testing with your head in the clouds, assumes that all risk is avoidable. Yeah, I wouldn't take that trade. One time a guy came to my office and skipped through, as he was backtesting, skipped through all of the negative trades and say, oh, I wouldn't take that one. Actually just said it to me, like, oh, I wouldn't take that one. I don't trade at like 11 o'clock in the morning. And he was assuming that all risk was avoidable. You can't make that assumption unless you could build rules that make the risk avoidable. Risk is not avoidable, but you can conservatively manage it, as our friend and associate Kenrick would like to say. Cloud testing skips the bad trades and explains them away. It trades 24 hours a day with no sleep. It takes profit near the target sometimes because it doesn't get all the way to the profit target, and you don't want to take a loss on something that got close, and you don't want to change your rules because you'd have to go back and take profit before the profit target on all the other trades. That's ridiculous. Just don't take the profit. Just let it stop out or whatever. Cloud testing includes a free time machine that allows you to go back in time and redo all your testing instantaneously because you don't want to have to go back and do it. Cloud testing has rules that are written in your head but not on paper because they change all the time. It's easy to say your rules are consistent if you don't have to write them down. I have seen people tell me that their rules are consistent and then write them down for me, and it looks like Sanskrit from ancient tablets written 1000 BC by some Indian prophet. I can't understand a word of it. Cloud testing works 3 different ways for 3 different people. If you give your testing method after your holdout period, if you give your hypothesis to 3 different people, and you give them the same length of time, the same time frame chart, and the same currency pair or stock, and they come out with 3 wildly different range of results, you have a problem. When Hector was moving through the process of testing his hypothesis on the bias trade, Michael sent some trades through using a Python script and grabbing data from the cloud. Also tested it on Dukascopy J4X, and I think 1 other trading platform. 3 ways for 3 different people was not the answer. In fact, there was also testing that was done manually back in time. So you had FXCM's strategy trader, Dukascopy's J4X, and a Python script running from a cloud producing results. And if they were all wildly different, there was a problem. You can't have your rules producing multiple different conclusions with 3 different people testing, because it's just going to produce some crazy result later on. Cloud testing caters to your need to be coddled and told what you want to hear, loves you unconditionally, never talks back to you, and is a complete waste of your time. Remember, the only thing that you need to know about testing is that a system is valid if it returns profit in exchange for acceptable risk. First, I want you to select an out-of-sample time period. It's got to be separate from the holdout time period, and you're going to need to get at least 100 to 500 trades from a variety of market conditions. I'm summarizing what an out-of-sample period looks like here. For a short-term trader, you might want thousands of trades. For a long-term trader, you might only need 75 more trades because you simply can't get a large number of trades. That's a problem, by the way. You do want trades taken from a variety of market conditions over the course of at least 100 to 500 trades. You can't use the holdout period as your out-of-sample period. Imagine for a moment that you're playing Keno in Las Vegas. You write down a bunch of numbers for a lady. She takes those numbers back into a dark room. Then she picks a bunch of numbers that are the winning numbers, and she comes back to you and she tells you that your numbers didn't win. Seems pretty reasonable, right? Seems like the game is rigged. If you choose the same period of time for your out-of-sample period of testing that you had from your holdout period, you are reconfirming what you already knew. You built a set of rules from a holdout period and said, this system works in the holdout period. Now let me test again over the same course of data using these rules. Oh my gosh, they work. If you create your rules from a period of time, in order to know if those rules are valid, remember, if it's returning enough profit in exchange for acceptable risk, you have to test during a separate time period. All right. If you chose 2006 to 2008 for your holdout period, then you might choose 2009 through 2011 for your out-of-sample period. It's pretty much as simple as that. You don't need to spend a giant amount of time freaking out about this. Remember, you're just going to test a more concrete hypothesis now. Your hypothesis in the out-of-sample period of testing is a clear set of rules. Emphasis on clear. We're not in the sandbox anymore. A very clear set of rules with credible evidence to back those rules up from your holdout testing period. In your holdout testing period, you were in the sandbox drafting a set of rules and doing some experimentation. In the out-of-sample period, you need a clear set of rules, written exactly, that have credible evidence to back them up. Otherwise, you're just wasting your time testing more stuff. If you blew through the holdout period and did 10 trades, made up a system, declared it a winner, and then moved on to your out-of-sample period with a bunch of rules in your head, you're just wasting your time. It's a complete waste of time. You might as well just randomly trade. In fact, you might as well stop this entire process and follow my other webinar series called One Page to Random Trading. And it goes like this. Take any trade you want, anytime you want it, cut it off quickly if it's a loser, and add to it if it's a winner, and hold on to it forever if you can. You might as well just do that. But I want you to live a clearer trading life. So you got to get a hypothesis ready, and it needs to be a clear set of rules with credible evidence to back them up from your holdout testing period, and you know what the rules look like from the last presentation. Rules for entries and exits and stops and limits and filters, moves to break even, and the like. Then you're going to experiment, and you will follow your rules precisely through the through the out-of-sample period of testing, and log your results in an honest manner. Let me say that in English because I messed it up. The experiment stage of out-of-sample testing says that you follow your rules precisely. No joking around here or changing the rules now. The changing of the rules came in the holdout period. If you start to change your rules, you are now back in your holdout period, which is fine, but you got to know where you are. You follow your rules precisely through the out-of-sample period and log your results in an honest manner. The question pops up, well, what if I find out that I'm testing here and it's not working? I don't want to waste the whole time. I've got an answer for you. During the out-of-sample period, you take 10 to 20% of the out-of-sample trades at a time and stop and do intermission analysis. Now, I'm making this up. I don't know if this is what people would do in the investment world. But this is what I would do. I would, if I had 200 trades that I were going to take in my out-of-sample period, I would take the first 20 to 30 of those trades, as many as 40, and stop and do some intermission analysis to make sure I'm not just wasting time. For example, you might ask, am I on track? Have I changed anything? Does this work? What risk am I taking? Are the risks ridiculous? What's confusing about this? You might also ask, are the trades opening at the correct time of day if it's an automated system? Are the trades opening the right number of trades? Is this working? The number one question you're always asking, am I getting a reasonable rate of return in exchange for reasonable risk? Now, you might not shut the whole thing off right now if the answers to these questions are negative, but at least you're stopping to think about it as you go. What if you're not on track? And what if the results are terrible? Do you automatically stop? Let me give you two examples with two different answers. What if your system is producing huge, consistent losses? What if you pop into this out-of-sample period and you just take 10 losses in a row and you're drawn down 70%? You took all the trades you were supposed to take, you took them just like you were supposed to, and it's blowing up. You have to stop. You have to stop and you have to go back to your holdout period because it's not working. You can't say, oh my gosh, well, that wouldn't really happen. You have to assume it's not just going to happen, but it's going to happen worse. So in that scenario, the answer is no, you have to stop and go back to the holdout period. However, what if the results are terrible and you look at your testing and you realize you're testing it, your automated method is opening up multiple trades at the wrong time of day? This is what happened the last time a group of us tested an automated method. It started producing random trades at the wrong time and the spreads were off and we had all kinds of reasons that we could fix it and then run it again and it would become more accurate. In that instance, we moved forward with our out-of-sample period after our intermission analysis. If the results are terrible, you need to repeat the holdout period sandbox creation and revision steps in webinar part 2. That might make you cry and you might really dislike that instruction. If you can move onward, then you continue testing 10 to 20% of your time period and you continue asking questions. You keep stopping and asking yourself, am I on track? Is this working? What's the risk? What's confusing? Is it opening up trades correctly? You might find during this time that you're really trading during the wrong time of day and you need to trade during a different time of day. And that puts you back in the holdout period. But honestly, it's not that long of a process now. You're really wrapping things up and there's a quicker and quicker cycle of hypothesis, experiment, analysis, experiment, analysis, experiment, and conclusion. The analysis that you do at the end of your out-of-sample period of testing includes standard features like win percentage, size of average win, size of your average loss, time of day, length of trade, biggest loss, Removing your largest win. What happens if you remove your largest win? Does the whole thing blow to pieces? Consistency. Is it producing stable returns month to month? I mean, do you get a small return every month? Or do you have some months that are giant and some months that are absolutely terrible? Most traders don't have the psychological stability to continue trading a method that goes through giant periods of massive drawdown. So don't assume that you're going to be able to do that. Your analysis also would include the standard question I keep asking, does this work? Which means, is the profit that it produces acceptable in exchange for the risk that it takes? What does this system cost you in terms of sleep, in terms of risk, in terms of development time to make it work? Is it worth the cost? And question all your assumptions. Don't become attached to a trading system just because you built it and because you love it with all of your heart. Don't do that. Your analysis will also include a Sharpe ratio. Remember, a spreadsheet can produce these ratios, and Wikipedia can teach you what these ratios are, and the best person who can teach you this is you. If you don't know what these words mean, stick with us in the webinar series, and then do a couple days of work to learn what this stuff means. It's all going to happen. You're going to figure it all out. One time I visited Deutsche Bank's trading desk, and I found this guy named Patrick sitting at his desk with an options book open. He'd gone to Harvard Business School and was sitting with a book on his desk, and he was actually trying to figure out the Black-Scholes formula as it related to a set of options. He literally had made it through Harvard Business School and was hired by Deutsche Bank to sit on the futures desk, and he still didn't know what the Black-Scholes formula was. And he was already hired. He was already getting paid. He stopped me. I was just a visitor. And he said, hey, do you have a minute? He thought I worked for the bank and was coming from upstairs and management, which is kind of funny. That'd be hilarious if I were managing anything at Deutsche Bank. But he was wondering if I could help him. And he got paid to sit there and learn about it. Well, you're the same. You get paid for this. You know, nobody's here to babysit you or teach you math. I mean, you got to do some of this on your own, right? So figure it out. You don't know what that word means? Figure it out. Don't wait for me. Get online and figure this crap out. You're a smart person. What's your drawdown? What does that mean? Figure it out. I mean, we'll do a webinar on Monday that helps you with this. Part 4 will concern some of this, but figure this stuff out. Don't wait for somebody to just spoon feed you stuff. Standard deviation of returns. If you're wondering what the heck that means, look it up. Type it into Google. If it takes you 2 weeks to figure it out, it's worth it. It's totally worth it. It's part of the job, right? You don't just go to your boss and say, well, this part of my job is really hard. I don't get it. I mean, if you said that, they might tell you you could go to a course, you could go to a school, but they're not going to tell you they'll just have somebody else do it for you. Look at the max consecutives, max consecutive losses, maximum consecutive winners, and then toss out the maximum consecutive winners and assume you'll have the maximum consecutive losers. The easiest way to know that something is going to happen with your trading system in the future is that it hasn't happened in the past. Name 2 or 3 things that didn't happen during your out-of-sample period of testing. Some people come to me and they say, I did my testing, and you know what didn't happen? I didn't even have a string of losses. I can't believe how good it was. My first answer to that is assume it will happen. Build it in. Just type it in. If you went through a period of time that were 50 consecutive winning trades in a row, build in 10 losers in a row, right smack dab in the middle of that. Do not assume that the best case scenario is going to happen. Don't walk away from your testing excited about it. Walk away from your testing ready to question the assumptions. Look at it. Say, is something weird here? Does it work only on 11 o'clock on Mondays? Question it. Ask yourself difficult questions about it. Criticize yourself and the work that you did. For an expanded look at analysis, you could go to j.mp/backtestbible and ask a lot of questions. Spend more time asking and less time concluding. Stop with the party. Take off your party hat and your celebration that your system is so awesome, and put on your skeptic hat and just ask yourself, am I crazy here? Am I doing something that isn't reasonable? Am I trying to fool myself for any reason? Temper your euphoria. If your system is profitable, try to think of 2 or 3 ways that it wouldn't be. Because you sleep, because you're lazy, because you're impulsive and you might take other trades, because the system depended on a really tight spread. Ask yourself, why might this not work? And if you exhaust all those reasons it might not work, and you can honestly tell yourself that the profit it achieves is acceptable in the face of the risk that it assumes, you're ready. You can move onward because your return to risk is acceptable. And if not, you repeat the holdout process, not the out-of-sample process. Because you can't change your rules in the out-of-sample process. You need to go back and change your rules in the holdout period and make sure that the holdout period works again with that hypothesis. Oftentimes I will see people change their trading method mid-cycle in the out-of-sample period and then say everything turned out okay. But what they don't realize is they tested 3 different sets of rules during the out-of-sample period and concluded the system was profitable. That's not honest, and that's not going to work. Because you can't do that in real life. You can't automatically switch like that. You can switch if your rules say that you should switch based on criteria. All along the way, ask yourself, am I following rules or am I changing rules? Ask yourself that honest question. I think I'm going to put that in the analysis. I'm going to do another slide right now that says that. Here's the question. Did you follow rules while you did your out-of-sample period, or did you change rules? Can you look back on every trade and say, yep, that was from the rules, that was from the rules? If it's not, throw it out. Just dump it out of the out-of-sample period. And then move onward if your return to risk is acceptable, and create the rules. The rules. The rules. Bolded, capital, underlined. This is a longer set of rules with a clear understanding of your risk metrics, exceptions to the rules, filters, and a plan for implementation. Risk metrics would include trade size and a clear understanding of your drawdown. Your longer set of rules would be a document that said, this is my trading system rules. This is what it historically produced as far as returns. This is what the holdout period produced. This is what the out-of-sample period produced. This was the deviation of returns. This is the trade size that's taken. And this is the plan for implementing it. I'm going to be awake during these hours of the day. I'm going to run the system during those hours of the day. I'm going to get these alarms to make sure that I can take the trade. And you're going to ask yourself at this stage, can you accelerate the performance of the system by automated alarms or trading robots? Do you notice that it requires that type of assistance? Not every system requires that. You can be like Scott Welsh and wait for the Boscillator reading to reach 500 and then start drawing trend lines. And you can just be at the computer and implement it. You don't need a robot for that. Scott might get alarms or whatever else that go off, but that's enough for Scott. But some systems benefit or even require such assistance. At the conclusion of your out-of-sample period, do you have conclusions about how things work or doubts? Would you argue with someone about your system? Would you stake your reputation on it? Your out-of-sample period of testing needs to produce such rock-solid conclusions that you would stake your reputation on it. If you would not, then you either suffer from a self-esteem problem, or you're falsely modest, or you truly didn't do your backtesting correctly, and you need to repeat it. Now, if you have self-esteem issues, then that's outside the scope of this presentation, and you need to solve those issues. A lot of people come to me with trading systems that work and say, I'm not so sure about it. And they're either falsely modest or they waste my time complaining to me about a trading system that's already profitable. And I don't want to hear it. And the reason is they should go make as much money as they can while it's working. Success is fleeting, and they need to be making money, not wondering how they can improve it or switch it or change it. And a lot of people wonder what I mean by that because I change trading systems from time to time. Here's how I change trading systems. I follow the process of how to test a trading method. But once a trading method works, I'm going to be making money from it. I'm not going to be sitting around trying to find ways that I can ruin it. And if it's working, I'm going to try to find ways to make sure I stay on track with it. That's what I'm going to do. In summary, you need to make honest assessments. You need to be willing to repeat steps. And you need to understand that conclusions can only be reached after the work is done. And then you move on to implementation. Implementation is not a part of this webinar series. But remember that the implementation of your trading method will only be as successful as your brain allows it to be. Who you are as a person and your personality traits and characteristics and your psychological stability will dictate how well you can implement a trading system. Some of the best trading systems in the world have been ruined by individuals who are not stable psychologically. So remember that you can do all this work, and if you're not a stable individual and you're likely to just be impulsive, you can ruin the whole process up to this point. And you need to make sure that you're spending enough time thinking about the psychology of trading. That's covered in the webinar series called The Trading Game, and I would direct your attention to that series on the subject matter of implementation. When we come back for part 4, we'll put it all together. We'll show a holdout period of testing, an out-of-sample period of testing, and describe the process that was used to do it, and explain how someone moves through each stage of the process that has been explained over the course of the first 3 parts of how to test a trading method. Thanks for joining me for part 3.